I think, Adrian, let's start off with you. And, when we talk about value investing, we keep hearing the word contrarian as well. Could you tell us about the principles behind this method and why you adhere to its principles in the format it is right now?
I think the first question about why do I adhere to the principles is simply given by the evidence, and the evidence is that of the different approaches or philosophies that you can adopt in investing, it would be, I think, generous to suggest that value has a monopoly on generating great performances. There are many different approaches and styles that have good track records, but through time, I am convinced that the way to approach investing is through value, and that is evidenced again and again by the great results that value delivers.
Okay, so let's look at it from a philosophical perspective. What does it mean to be a value investor from that perspective, and then also fundamentally?
I think it means different things to different people. Value is also not a single way of approaching the market. There are many different flavors and styles of value investing. Probably the most obvious ways to measure value would first be in terms of, is the investor backward looking or forward looking? To what extent do they consider the past as being a guide to the future, or are they just looking forward to try and figure out what tomorrow looks like? I think that's a first important differentiator between types of value. And a second important differentiator between types of value is the extent to which the investor places emphasis on qualitative over quantitative metrics. And some value investors would place a very high emphasis on quality. Other value investors may emphasize quantity
okay, so what is your philosophy?
Well,
is it amalgamation of both of the elements?
In your introduction, you alluded to Benjamin Graham as being the father of value investing, and in this way I would define myself as being very old-fashioned value. Yeah. I think that there is a tremendous amount of information captured in what we already know, and that the future is incredibly hard to foresee, and there's lots of anecdotal evidence we can give to support that, as well as hard empirical evidence. So I tend to place a very high weight on what we already know. Buffett says that if you look at financials, there's only two numbers that you can believe. One is the page number and the other is the dividend. And this is what underscores backward looking. And whilst I think initially I considered myself to be very hard numbers driven, over the years I have learnt the importance that quality plays in businesses, and for that reason I've come to place a greater emphasis over time on qualitative aspects as opposed to
quantitative.
Yeah.
Fascinating. Kikubi, let's get you into this as well. Specific mindset that is involved in this type of investing.
You see, I think the one thing that we haven't alluded to yet, or we might have in part alluded to, is the fact that markets are driven by emotion at the end of the day. It's not necessarily driven by hard facts over the short term. So, I always like saying that the rules are simple, but the game is difficult. And that is unfortunately one thing that investors often don't see. Is it's easy to adhere to the principles of being a value investor. It's easy just to look at the principles and to say, well, how do I apply this? And it's easy for people to look at it and just say, look, let's just blanket do this. But once you start applying it to a real life situation, and when you're looking at markets, often you have to have patience when other people are piling into markets. Often that is usually what distinguishes the very good managers from the bad managers. And often you can't see it in the heat of the moment. You often see that in retrospect when you look back in time and you go, wow, that was a great decision, but it often could be quite a bad decision at the time, or be viewed as a really bad decision, predominantly because it was just done in a time when there's just so much momentum in the cycle.
Exactly, because you could either get caught in the hype or in the fear, essentially, Roland. So what are some of the risks that are involved in value investing, or would you say that it's pretty much safe?
Well,
if you look at the fundamentals as well as the quality.
Value investing certainly is a valuable way to invest in the long run. There is something called the value risk premium, which is something that you get for taking on the risk of value stocks. So there is risk involved. In fact, value is quite cyclical. There are 2-3 years when value will do well and 2-3 years when it might not do that well. The opposite of value used to be considered growth investing. Our sort of research looks very much more at momentum kind of investing. So what a value investor has to do is has to convince their clients that they've got to stick with them for the long run, because there could be short periods of a couple of years where one actually doesn't do that well. So finding the economic cycle when value does well obviously can allow you to outperform. But what do you do in the periods when the economic cycle is not necessarily in the favour of value? And there are times like that.
Well, Adrian, interesting points that Roland mentions: value, risk, premium. But then again, when you look at growth investing, you pay a premium anyway for those growth kind of stocks. So either way, you'll be paying a premium. So it is very cyclical. It is a cyclical game. Do you see yourself as someone that focuses on companies that no one else wants to touch? Could we put it simply as that?
I think you can capture it fairly simply by that word of, we describe ourselves at Cannon as deep value. Contrarian is another term that you might use to explain our style of investing. And it's not that no one else would touch the stocks that we invest in, it's rather that they are off many people's radar, they've fallen out of favor, investors are out of love, and given that disinterest, often in some really well-run, good quality businesses, you are presented with a great investment opportunity.
Okay.
You see, I mean, and I think that's the important thing. Let's assume we took the whole market today and we made it a private equity market. So we delisted absolutely everything and we put them all into private equity vehicles, and we just said, fine, we're going to calculate the internal rate of return for each one of these businesses, and we're going to put a value to it. Well, quite frankly, if a business is worth 100 million today and there's a downturn in the economy, guess what we're going to be doing as investors? We're going to be sitting on our hands. We're going to be saying, well, we're not going to part with this stock. We're going to hold it. We're going to own the company. And if people say, what's it worth? We'll say it's worth 100 million. And if we're really desperate for cash, we'll say 95 million. But you see, the market doesn't behave that way. Yeah. So you're waiting for a detachment between price and earnings, or price, which then gives you that buying opportunity. And that's the beauty of having listed entities. So often when you look at markets, when they price for perfection, you know, you're not getting that ability in the market. But when you get the ability, you should be able to act in accordance with that, because quite frankly, the long-term numbers are there. As a matter of fact, if you take price to earnings ratios, we've done this on the show, Lenny. Yeah. So we take price to earnings ratios and we look at the returns that you can get on a 5-year basis, on a real basis, and on an absolute basis. The cheaper you pay for companies, the higher the return, and vice versa. Pay up for companies, guess what? You're not making any money for those kind of companies in the future. And I mean, that is crucial to value-based fund management.
Okay, so where do value traps then fall into play?
Value traps come into play where you get
and
the
have
quality.
You been trapped before, Adrian?
Absolutely. You know, they say that there's only 2 types of bicycle riders: those who have fallen off and those who are going to fall off. I think there's in the same way.
Hopefully you've already fallen off, so you're on your way to seeing good profits.
If you are a dyed-in-the-wool value investor, I would find it impossible to imagine that there haven't been times when you've been caught in value traps, in the same way that growth investors have been duped by buying stocks that just don't deliver. So yes, I can give you examples of companies which appear on the surface to offer fantastic prospects, and with time, a change in dynamic, a change in industry condition, or perhaps the past coming back to haunt a company, it transpires that the business is not quite what it seemed.
Okay, Roland, let's take a look at economic cycles that favour value investing. And we know that during the crisis, clearly value investors also had quite, I would say, a field day, if I could stand to be corrected, perhaps, because there were a lot of companies, good quality companies, that literally fell off a cliff. What other economic cycles favour value investing?
That's a good question, quite a difficult question as well, because generally when you find value doing well is when the market is surprised, in the sense that there are opportunities that open up which the market wasn't aware of. Whereas if everybody's thinking in the same way, you know, they say if everyone's thinking alike, somebody isn't thinking. So you tend to have this blind market following things. That is a momentum kind of market, and value doesn't do well in that. So prior to the tech bubble, everyone was thinking alike, that, you know, tech is the place to be. When there are surprises in economic data. So for example, let's take inflation at the moment. Yeah. Everyone's worried that inflation is going to go up, and I'm also worried inflation is going to go up, but we're all worried about inflation. So is it unexpected? Maybe not as much as we would like it to be, but if inflation surprises by even more than the general consensus is, then you're going to see stocks opening up in terms of valuation opportunities, where value investors who've got obviously skill, knowing that the inflation rate is going to surprise, can pick up bargains. But the risk always with a value investor,
instead of reactive to economic data, you sort of expect it, and then therefore this term pricing in then comes in.
The risk with a value investor is they get in too early, and the risk with a growth or momentum investor is that they get out too late. So are you buying the stock, you know, it's cheap for a reason, it's going to carry on doing badly, or is it at the bottom. You know, that's the risk you always face.
That's why I always say, I mean, investors, pick what you are. Understand what it is that you're trying to achieve. Understand what the fund manager is trying to achieve on your behalf, and are you trying to achieve exactly the same things? Because if you're a good value manager and you're prepared to stick with a value style as an investor with that manager, you're probably long term going to make money, regardless of what happens over the very short term. But most investors don't do this. They want both the momentum cycle and the value cycle, and they want to own both of them both at the same time, and they want to try and do as well as everybody else all the time. And that unfortunately just doesn't happen. It's just not something that is viable.
Adrian, Roland perhaps was alluding to it. In terms of timing, growth investors get it wrong, value investors get it wrong. Do you get it wrong?
Timing, if you can get timing...
Is it about timing for you as well?
No. Timing would be critical if our philosophy and process implied that we can get it right. Our philosophy, our approach to investing is we think that timing is incredibly hard to get right. And despite that, what you see again and again is people trying to time the market, and the evidence that we have again and again is that people are hopeless at market timing. So whilst timing is on paper very, very elegant, it's hard to get right, and for that reason we de-emphasize timing and instead focus on the two things that are inside of our control. And the one is understanding what we are buying, and second, knowing the price that we pay for what we're invested in. Funnily enough, the profit that you achieve, or the return that you achieve on an investment, is determined not so much by the price that you ultimately sell at, but rather by the price that you pay when you enter the investment.
I mean, that's interesting, Adrian, but wouldn't you say by default, if you can control the price that you pay for an investment, hence you understand the fair value for a business, and hence you're prepared to pay it at a discount, you're prepared to pay a discount for that, or at a discount, are you not by default of that then controlling timing as well at the end of the day?
Well, I suppose you're right. I agree with that point, but it's not that we are imagining ourselves or acting as if we are brilliant market timers and that we know just the week or just the month when building and construction stocks are going to top out and collapse, or when they're going to trough and start soaring. We don't see that as a skill in our armory.
So timing basically at the end of the day is then a factor which is controlled by things such as price and understanding the business that you want to buy. Just to quickly give us an indication here from a factor perspective, you know, are there factors that are more important in value investing? If you just look at it from a regressive perspective, so you go back in time, is there certain things that are more important and show a better correlation with good returns over time? And are there certain factors that maybe aren't that important?
Well, I think this is where Roland spends a lot of his time. But Kobus, you alluded to this earlier with the price earnings multiple as a determiner of future returns. The types of factors that we consider to be critical in guiding future returns, simple metrics. The three most important would be price earnings, dividend yield, and price book. Price earnings, though, I would elevate the importance of through the cycle price earnings rather than just last year's trailing earnings or next year's forecast earnings. We give a far greater weight to what we call through the cycle or DNA earnings.
Okay, I'd like to touch on the ETF markets. We know that most investors piling into ETFs, and perhaps asset managers in a sense not so much in vogue due to the financial crisis and due to some of the troubles that we saw ensuing there. So investors looking at other methods of making money. With regards to the quantitative characteristics associated with value style investing, would you say that you are finding yourself in a challenging position to convince people to rather come to an asset manager such as yourself as opposed to invest in an ETF?
That's a great question and a very important one. We've done a lot of work internally to satisfy ourselves that what we are doing is more effective than a simple quantitative approach, because a quantitative approach would say, I want a portfolio that has just low PE stocks or some combination of low PE, high dividend yield, low price book stocks, and so you can build a black box that runs this type of investment for you. And the results that we've generated over the years demonstrate, first, not only does this type of value bias build very effective investment returns, but that what Cannon does in terms of qualitative overlays adds value to that black box.
And Roland, if we could get your input here as a quant, your view on the qualitative aspects.
Look, there are times when there are opportunities where kicking the tires, seeing management and doing your analysis can add value over and above a mechanical kind of index approach. But I do think that there are simple ways that one can capture the bulk of the value effect. The fine art of value investing is obviously left up to human investors or to people who've got some level of skill. But something simple like the FTSE JSE Dividend Plus Index just weights shares with a high dividend yield more than other shares. And has done really well. Over the last 3 years, it's literally beaten most, in fact, nearly all general equity fund managers out there. So you can capture the value effect mechanically, but anything over and above that, you'd need some kind of human filtering.